Hello.
Great. Awesome. Okay. Wow, you sound good.
Yeah.
It's like a podcast kind of voice. Well, welcome everyone to our June New York Tech Week themed fundraising workshop with Danielle Lay from NEA. We're really excited that you guys could make it. I know it's a very oversubscribed and busy week, so we're glad you chose this event. Next slide, please. So just to give you a quick overview, this session is going to be recorded, so you'll be getting a recording of the webinar afterwards. Next slide. And we started this workshop series really to help open source a lot of the thinking around fundraising for the founders we serve. So quick overview about SVB. We have been the bank for the innovation economy for over 4 decades now. We're founded in Silicon Valley. We sit between founders and VCs. So where we play is really in that kind of middle space of the Venn diagram. And we really want to be market makers in some ways, and where we can essentially create serendipity for the founders who are clients, introducing them to other like-minded folks, VCs, corporate buyers, etc. So this workshop, is an opportunity for you to, reach over, talk to the person next to you, see where serendipity strikes. Great. And a little bit about myself. So my name is Danielle Lay. I'm the managing director of startup banking out here in New York at Silicon Valley Bank. I've been with the bank for over 4 years now. I actually started out as a SVB client at the first startup I joined called Sunrun, solar renewable energy company. And then I moved into the world of product management for the first arc of my career. So I built consumer social at Instagram, Facebook, back when it was still Facebook, and Tumblr. Then I moved into the world of investing in CVC at Samsung Next. And now I support early stage founders from idea on a napkin sketch all the way up to Series A through helping you with fundraising, company building advisory, and connectivity to the larger SVB ecosystem. Great. And we're joined today with our awesome guest, Danielle Lay, who is a partner at NEA in the New York office. She focuses on consumer tech and AI application companies. A couple of her portfolio companies include Beehive, Patreon, Goody, Fizz, just to name a few. Previously, she began her career in investment banking, covering fintech at Goldman Sachs, and she graduated from Northwestern studying econ, business, and Chinese. So welcome, Danielle.
Thank you very much.
All right, let's dive into it. So how we start every fundraising workshop is really giving you an overview of the state of the market. What is the current private public market looking like as you walk into your fundraise? So feel free to download our state of the market report. This is a quarterly report our market insights team generates, and a source of a lot of where our data comes from. Okay, a quick disclaimer. Fundraising is a very bespoke process. The data here is very, specific to New York and San Francisco. So please know that, you may have to kind of individualize. And also the data here is from 2022 to 2025. Great. So let's get started. In the world of seed investing, a lot of founders come to us asking, where should I anchor my valuation? What does good price look like in the last couple of years from 2021? We have been tracking this, and enterprise software, has been a stayed about steady at around a median valuation of 3 million. And we've also seen consumer stay steady-ish, dropping a little bit from 2023 to 2024, from 2.1 to 2. And frontier tech, I think, is a huge surprise. That actually has increased quite dramatically from 2023 to 2024, given, a lot of renewed enthusiasm in investing in infrastructure, physical AI hardware, as well as we do see some continued growth in climate tech. So Danielle, curious, as a seed and Series A investor, how do you advise founders to kind of think about pricing and valuation in a down market?
Yeah. Well, one quick observation on this slide is that a few interesting things. One is the trend kind of intra-sector over time. And then two is the size of the rounds from inter-sector, so sector to sector. It makes sense to me that enterprise, frontier, and climate, as an example, would be higher than consumer in terms of medium round size at the seed. Because if you think about it, if you're an enterprise software company, you need to build up a sales force. You need to hire salespeople. In the case of frontier and climate, in a lot of cases, there might be more capital expenditure, more hardware upstart type costs. Whereas for consumer, and this is one of the things I love about consumer, is you just build it and then you put it into the world and people like it or they don't. So it makes sense that the number would be smaller. In terms of your question of how to think about valuation at the early stages, there's a lot less range at the early stage, in my opinion, with respect to just absolute number. It's infrequent that you would see a seed or a pre-seed being raised, or I should say, yeah, a YC type seed being raised at above a $25 million valuation. And so there, in terms of just absolute number, there's more compression in the seed relative to other rounds. But in terms of percentage, the range can look quite big. And what I would say, I'm not just saying this because I'm at a venture firm and I'm an investor, but I do think just prioritize the right partners. If you pick the right people, that will pay dividends over time. And whether those right people offer you a higher valuation or a lower valuation, those numbers aren't really real until you exit anyway. That ultimately is the most real number. So at the early stages, it's really just about finding the right partners and setting yourself up for success.
Yeah, that's super well said, because it's a function of whatever the company is that's going to be your exit. And if it's F of zero, it's zero, right? So definitely, I think, to your point, valuation is not a hill to die on, especially in the early stage. So let's go a little bit deeper into seed extension, because that has been also a common topic in the last couple of years, especially since the peak of the market in 2021. We're seeing a lot more seed extensions from seed deals that were raised in that 2020, 2021 boom. And about right now, 35% of all seed deals are extensions. We've also noticed that the companies that have raised seed more recently in 2022 are not needing as many extensions, given the cash burn is more conservative and just overall cash efficiency. But one thing, Danielle, a lot of founders ask us is just, what are the optics of a seed extension? Are down rounds really that bad, or is it paramount to survival these days?
Yeah, it's a great question. I think there are two questions inside of that question. One is, what are the optics of, at the moment that you're deciding whether or not to raise an seed extension or an A, what are the optics at that point? And then what are the optics later if you decided to raise a seed extension for raising a Series A? For the first question, I would say Series A comes with expectations, depending on the sector, there are certain expectations on what a Series A should look like, what a Series A company should look like, what the traction should be. And sometimes there are exceptions to the rule for sure. But generally speaking, I think to go into the process with confidence, if you know you're not quite there yet, I really think it makes sense to raise a seed extension. And you'd rather be in a position of strength and raising a seed extension that maybe you feel oh, we're kind of cuspy between a seed and an A, but just going out for the seed for now, then it would be to go out with an A that you think you're not totally ready for. So that's the first question. In terms of the second question, what the optics are of having raised a seed extension, that doesn't bother me at all as an investor. I think a lot of investors would sit here and say the same thing. it's, of course, we'll look at, what resources did you have, how capital efficient were you to get to the Series A? What resources did you have to deploy to get to the Series A? But ultimately, we're looking at the Series A as a Series A. It's like, where are you in that moment in time and where are you going to go moving forward? And so the fact that you maybe raised an extra $2 million or raised an extra, or however many low single digit number of $1 million, either at the same valuation as your seed or at a slightly higher valuation as your seed, to me, it's not that impactful.
Yeah, so it sounds like keeping a long-term outlook here.
100%.
Yeah, great. So these days, there's really a tale of two cities, as we like to call it here on SVB, is there's the AI boom, and then there's everyone else who's not in the AI hype cycle. And one of the analogies we like to give is that since 2021, when, ChatGPT really became commercialized, we've seen a huge boom in not just AI adoption on the consumer and enterprise side, but also a huge bump in the deployment of venture capital. And one of the analogies we give here is similar to the mobile, boom in the early 2010s. So I worked at Facebook in that era. It's like once you decide, okay, Mark's like Facebook is mobile first, every single product becomes mobile first. Other competitors start to follow suit. And that's kind of a similar phenomenon we're seeing with AI. Is like once the large incumbents are realizing they have to become AI native, or existing incumbents retrofitting AI, we're seeing most companies now have some degree of AI. So I think the question for you, Danielle, is like, having been in this space for so long, does this growth curve, the blue we're looking at, projected growth of AI, venture deployment is going to grow by 50 to 60% in 2025, does that seem, accurate, or are you seeing a lot more deals getting done than what we're capturing here?
Yeah, I was surprised by this chart. If you look at just, my eyes aren't very good. Let me see this one. Yeah, if you look at just Q4 of 24, the green relative to the blue, obviously the blue has grown a lot, but I would have suspected the green shrunk even more and the blue grew even more. And it might just be like investors are always thinking about what's new. They're thinking about what's next. So it might just be a reflection more of that mindset, but that's what I would have expected. And I certainly would expect the blue to continue growing. I think I've spoken to some non-AI founders who feel this way. They're like, this is so frustrating. Like, what about the rest of us? We're still bringing value to our customers. Like, how do we think about this? And I think ultimately it's about why now? Like every company that we're looking at, there's this great analogy that some very storied investor whose name I'm forgetting made of, you can build a great ship, but if the wind is not behind your sails, like you're not going to get very far. Or you can build like a kind of meh ship, but if the wind are behind your sails, you'll probably get further than the great ship with bad conditions. So like that's kind of how we think about, in an ideal world, you want to be in the best ship in the best conditions, but we're always like testing the winds. Where are the winds going? Who's going to grow as a consequence of having the best ship and having the right winds that are pushing them in the right direction? And I think that's why everyone's so focused on AI. But if you are building a company that has some other, really compelling and strong why now, and really compelling and strong wind that is either related to AI or not related to AI, that is going to push you and your company forward meaningfully over the course of the next 5 to 10 years, like we're all very compelled and excited about that as well.
Yeah. That reminds me a lot of what Anne Marico from Blake told me, which is very similar, and I wonder if this is similar to the storied investor. Yeah, she basically was like, look, bro, like, we're not here to just pick winners based off of one thing. You can have a good team and meh market and a great product and still lose to a, okay team, great market, and bad product, and that was really eye-opening for me.
100%, yeah.
So we're all looking for the wind. Awesome. Cool. So let's transition into a lot of the NEA way of thinking, because that's really what I think is the secret sauce to our fundraising workshop is peering into your brain, Danielle. So take us away to like the NEA world, the worldview, the thesis, and what gets you excited these days.
100%. Thanks, Bo. So this is a chart of kind of the stack. And this is really how we think about our investing practice and also our investing team, frankly, on the tech side. You have the frontier layer at the bottom, then you have the infrastructure layer in the middle, and then you have the application layer at the top. Frontier layer and to some extent infrastructure layer, the incumbents have an advantage, oftentimes in part because they have distribution already, and also because it's really expensive to build up those lower parts of the layer. And then the kind of higher parts of the pyramid application layer, that's where I spend most of my time. So I'm biased to say this, but that's where startups and upstart companies really have an advantage. Lower capital intensity, consumers and enterprises, buyers are always looking for like, what's the best new thing? And they don't typically look for that or they don't always look for that in the infrastructure and frontier layers. Those are more like risk averse purchases. So this is generally how we think about the world today. You can apply it to AI, you can apply it to like any prior technology wave. This is obviously AI centric, but that's how we're thinking about things.
Are there any advancements in physical AI at the silicon layer, compiler layer, or data center layer that gets you excited about how that could potentially change the rate of AI tooling, profitability, all the other kind of knock-on effects?
100%. I think it's the capital. We'll go through this, I think, in maybe the next slide or the slide after. Yeah, right here. It's the capital expenditure that really drives the application layer adoption. So these are a few different charts to demonstrate the pace of adoption. And what happened in prior waves for mobile, as an example, consumers had to buy mobile phones, they had to buy smartphones, and that process didn't happen overnight. Consumers were the ones who had to make physical product purchases in order for the penetration to go up and therefore for the apps to like really thrive and have a big enough customer base. The AI penetration has happened so quickly because it's not in the hands of consumers. Our devices are the same, desktops, mobile, iPad, whatever you're using. So the devices are the same. We haven't had to purchase new devices to access the technology. And all the incumbents are the ones that are spending tremendous amounts of billions of dollars of capital expenditure to grow both the technology and the volume of data centers, of infrastructure to deliver these products. And so this is a cycle where it's like very much inspired by the bottom, which facilitated like, the infrastructure and then the applications. And yeah, it's a big part of why we're excited and why I think everyone is feeling this like, wow, this happened so fast. Like ChatGPT just had its big moment, 2.5 years ago, but we're now here with like seemingly, I think still a very early ecosystem, but in some ways like a much more ecosystem than we would have seen 2 years into the mobile wave, for example. Okay, this is a little bit about consumer. So I spent a lot of time, as I mentioned earlier, on both B2B applications and B2C applications in AI. On the consumer side, so on the B2C side, most of the value thus far has accrued to two things. It's accrued to answer engines and it's accrued to creativity tools. So answer engines are, ChatGPT, Perplexity, of course, and the creativity tools are companies like 11 Labs, Captions, Midjourney, I think is on there. I think this chart is just as of February, but the numbers probably like continue going up and to the right for combined visits per month for all these companies. So those are the products on the consumer side that have generated really strong product market fit. There's still a lot of testing ongoing for other use cases inside of consumer. There were a few logos over here, which I took off because I didn't want to shame any companies that are experimenting on the consumer side, but there's been a lot of hype around certain products, and as you see, there's like a pretty precipitous drop off for a lot of those companies as well on the left side. So this is all to say, I think it's still really early. We found those two really enduring core use cases, and there's still a lot of other opportunity in consumer AI.
Given the experimental nature of consumer AI, how are you thinking about new ways of measuring retention? Like when I was at Facebook, like we lived and died by DAUs, MAUs, L7. Are there new ways of measuring retention, given the fact that newer users are actually quite fickle? You know, they want to test a lot of stuff, but it's not real reoccurring revenue.
Yeah. On the B2B side, people are using this terminology called YAR right now instead of annual recurring revenue, experimental recurring revenue, because you're seeing a lot of companies have a very similar effect on the B2B side. They'll sign like a 1 month, 3-month contract, but then like people will churn. And you have a lot of enterprises that are very willing, any buyer right now is like, how do I make sure my org is at the forefront of AI, like using all the tools. The only way you do that is try a lot of tools. And so you have a lot of venture-backed companies that are raising off of these tremendous growth numbers, but then a few months go by and they churn. So that's on the B2B side. On the B2C side, honestly, it's the same metrics. And I think it makes sense that it's the same metrics because you have to have the restraint to hold these new companies to the same bar as you used to hold the prior companies. And what you'll see for the new companies is the growth in some cases is much faster than the average in the past because of this experimental nature of AI tooling and products. But you have to hold them to the same retention bar. Like I think product market fit looks the same. Growth is a reflection of received product market fit. Retention is a reflection of actual product market fit.
That's so well said. That's literally what every consumer product manager has ever tried to craft. Awesome. All right.
Okay, what we're looking for. Again, this is on the consumer side, but I think a lot of this can actually be applied to the B2B app side as well. What we're looking for in companies. One, observed, not prescriptive. That's a reflection of what's the best way to say this? I think for the best companies, once they have a product out in market and they have some product market fit, their next 6 to 12 month roadmap, if you ask them, is like super clear. And it's super clear because their customers are telling them exactly what they need and exactly what they want. They're saying, hey, I'm using this 5 times a week for this particular use case. It would be really, really, really helpful if you could also do these other 3 things. And if you're seeing that volume, then it should be pretty clear what you should be building towards. Enduring behavior, we just talked about. Viral growth. So it's really hard to cut through the noise these days. I think it was easier at the beginning of this technology cycle to build okay product with really cool technology that either you built or someone else built, but like okay product. But there's such a magic moment of like, do you guys remember that app that like turned you paid it like $100 and it turned you into like a space alien? Like an AI version of Space Alien, and then everyone's LinkedIn's were like them as fairies for like 6 months. I don't know what the company was called. Like, I don't know if that was good product, but it was really cool technology. And because it was really cool technology, it can kind of get away with having okay product. So the great product right now is a part of what's driving viral growth, but you really have to be great storytellers and be where your customers are and tell really compelling, interesting, novel stories to get their attention. Chips fast with absurd headcount efficiency, self-explanatory. It's a very competitive market right now. You're hearing a lot of this messaging on X, so I won't repeat it. And distribution mindset, we kind of talked about a little bit already as well. But these are generally the things that we're looking for these days.
So given the fact that things are changing so quickly, it's like a month is a year in this AI world. We have created an AI, not AI, consumer tech hype cycle to gut check our VCs with. So curious to see where you agree and disagree and what are things you're excited about on this hype cycle. There are no wrong answers. You can be so stoked, which is innovation trigger, to like not so interested, disillusionment, to all the way to plateau productivity.
Yeah. I was telling Bo when we caught up a couple days ago that I've seen the first three parts of this chart before, never slope of enlightenment and plateau productivity, and the alliteration is really amazing. I would say a few things. Gen AI for text, I agree. Customer chatbots, I would put closer to the peak, maybe on its slope on the way down. AR, VR, I would move somewhere else that's not on that hill. I feel like it's just not even part of the conversation right now, unfortunately.
Yeah, I agree.
Yeah. Gen AI for video, AI assistants, I would put agentic AI just as a term at the very top.
Yeah. That's a local maximum, right?
Yeah, and then I think a lot of this like physical AI stuff is on the rise. Certainly, a lot very actively part of the zeitgeist and growing. Great. Next slide.
So talking more around consumer behavior and trying to find retention, we've done some analysis around time spent on screen time and how that correlates to monetization. And one of the interesting findings is, the TikTokification of American minds. The bulk of time spent is still on social media, and TikTok has a growing share of that. And then we're seeing, newer apps having less retention. You might try Revolve for once or twice, but then you don't go back. And that also trickles down to monetization, where like the bulk of spend in average American households still towards film and TV, then social media. So as newcomers, consumer AI or enterprise companies that may want to, take some of the time spent, get a slice out of this pie. How do you recommend founders think about this type of, kind of dwindling new appetite for trying new tools?
Yeah, 100%. It's interesting because if you look at, with the exception of cloud storage, which people, I'm guessing that's like Google Photos and stuff like that. The monetization is really all entertainment. Like that's all entertainment. Maybe gyms and fitness don't fall into that category, but social media is certainly entertainment. Dating apps are, for better or for worse, entertainment. I think that's what a lot of people use them for. I'm really excited about new utility drivers in this generation of consumer AI. If you think about the last consumer technology cycle, the biggest outcomes are companies like Airbnb and Uber and Coinbase and DoorDash. Those are all utility driving platforms. So curious what this next generation looks like for that. And I can't stop thinking about TikTok because I think we tend to think of it as like a young person's app, but it's not. It's like every person in America's app.
I get my best travel recommendations now
From TikTok, yeah. And honestly, a lot of search, even before Google started talking about search disintermediation happening with the AI answer engines, they were seeing a lot of search disintermediation happening with TikTok because people would use TikTok to search for stuff.
Yeah.
And so I think because it's no longer, it's such a big company and it has a lot of complicated there's a lot of complicated context there that we all know. So it's not really like a venture company anymore, so we don't really talk about it. But it's just like so dominant in consumer life. And then the other one I'd assume is on this list for young people is YouTube. YouTube has such powerful endurance for young people and for Gen Z. I think the average session time for Gen Z is like an insanely high number on a daily basis.
What about new content formats? We talked about my friend Henry Song, shameless plug, one of the best Facebook product managers I've ever worked with. He is working on a company called Keynote Technologies, and he's met with Henry. So what are your thoughts about this short form drama? It's a market that's grown to 7.2 billion. I think in 2025 alone in China, it's generated $3.3 billion in revenue. It's projected to grow to 11.9 billion in valuation for this entire market. Like, do you think it's going to come to the US soon?
It sounds like it already is. And for reference, Bo's friend Henry, everything I know about this sector started with my conversation with him. He is amazing. But yeah, my understanding is these short form dramas, for context, they're, I think, like 1 to 5 minute episodes. And each episode you have, like, when you download these apps, the first 5 or 6 episodes are free. And then you have to pay microtransactions to access every next episode, but the content is formatted such that it's like a cliffhanger at the end of every very short episode. And it's captured a lot of the content on these platforms to date are NSFW, not safe for work, or marginally not safe for work. And so I don't think people are talking about the fact that these companies have had tremendous traction in the US already. But if you look at the numbers, there are probably like 5 or 6 big companies in the space that are, gaining a lot of share in the US. And the numbers for like the percentage of adults that are monthly active users of these apps in China are crazy. I don't want to misquote the number, but it's like a high double-digit number.
Why do you think that is? Is the attention economy starting to shrink to the fact that we can't even sit and watch something for an hour at a time?
Yeah, I think that's part of it. I think I noticed this with TikTok. This is just like personal anecdote. I try very hard not to use TikTok anymore. I deleted it from my phone because I know what you do. Thank you. Please think highly of me. It's just like made it really hard for me to focus because I was watching these like sub 30-second clips and then scroll, sub 30-second clips and then scroll. And the impact on your brain is like pretty meaningful after a period of time. You can actually feel it. It's hard to focus. And this is like a new monetized version of that in some ways. And there have always been new content form factors, podcasts, YouTube vlogs, TikTok, Instagram, streaming, TV. These are all like new content form factors that have really captured the consumer at the right moment in time with the right type of content. And I think it's very possible that this new format is the next.
That's exciting. Well, we'll see where this takes us. Awesome. So diving more into the tactical bolts of fundraising. Obviously, this is a sales cycle. There's a process to run. This is like our textbook slide around just trying to figure out the taxonomy of like where you sit as a founder when you're fundraising. Are you the pre-seed camp, the seed camp, the Series A? And the reason why I bring it up is because there's been a lot of change. The markers have been shifting in the last 5 to 10 years. What is now a seed was a Series A 10 years ago. So would love to kind of get some of your reactions, Danielle, about like how you tend to divide up the world, when you look at something as a true seed versus a pre-seed.
Yeah, there are some founders that either because, they have a lot of credibility, or it's their second company and they already know, who they want to raise money from. They'll jump straight from founding a company to a seed. And the fact that it's the first financing doesn't really dictate whether or not it's a seed or pre-seed. I think it's more about the size. So I really agree with this. The size and the stage of the company. So I really agree with this breakdown. Let's
I think
see.
Series A is a little bit harder to pinpoint now, right? Because the markers have moved even more.
Yeah, for sure. The markers have moved even more, and it is different for different sectors. The markers are different for different sectors as well. I would say generally with Series A, if you're an ARR based business, you probably want to be $1 million of ARR plus, like at 1.1 to 1.5 million plus. Like that's generally where we see Series A. And then the divergence of the Series B is even greater. You can have companies of the Series B that have like 5 million of ARR. You can have companies, you can have companies of the Series B that are like 30 million of ARR. There's just a lot of range. Typically, the Series A is when you have early signs of product market fit. That's when you raise the Series A, and you're raising capital to fully prove that product market fit. The seed is typically, it used to be pre-launch. Now I think a lot of seeds are, we just have a working product that we're putting in the hands of users now. But it's very, very early. And then pre-seed is certainly pre-launch.
For consumer, do you think ways of showing traction could be in the form of wait lists or, early kind of beta testing? And what does that look like for you?
Yeah, definitely. At the Series A, for me, I definitely want to see numbers and traction and early product market fit. I don't think, like I said earlier, growth is a reflection of perceived product market fit. Retention is a reflection of actual product market fit. If it's just a huge wait list, there are exceptions to everything, but for me, I think I don't know if I would totally get there at the Series A. And then at the seed, at the seed, the data points are just much more nebulous, and so that could make sense at the seed.
And that 1 million ARR mark, was that for consumer or enterprise or both?
I was thinking more for enterprise, just because not all consumer companies have ARR. But I think if you're a consumer AI, consumer software company that does have ARR, I think that could make sense too.
Cool. All right, so we're gonna fly through a couple slides. This one's pretty easy, so I think we can skip. There's a seasonality to fundraising. Do you have any hot takes?
I do have one thing to defend our industry really quick. I think everyone's under the impression that all venture capitalists go on vacation from July to August, and that's a long time to take vacation, and it's not true. And it's certainly not true for me. I will be working all summer.
I was cranking all summer.
I'll be cranking all summer. The issue is that the way we vote and make decisions, you need a certain number of people to be around. And so there's kind of this rolling, because people's kids are out during the summer. So there's this rolling period where it's hard to get people to schedule things, to get everyone there to schedule things, because there's probably someone on vacation.
You need quorum.
Yeah, exactly. You need quorum. There's probably someone on vacation between July and August. So please know we work very hard. We work very hard.
Very responsive.
Yes, thank you very much. We work very hard to work with the best founders. So yeah, but this chart I very much agree with.
Yeah. Cool. In terms of running fundraising as a sales funnel, any tips around just generating the initial list and prioritizing them? Because we've been told founders are like, this is my dream investor. Should I talk to them for the first meeting? And the answer is usually no. Talk to some safe people who are more forgiving so you can make mistakes while they're still cheap. What is the sales funnel you recommend your founders think through?
I agree with that completely. I think if to the extent you can, to the extent investors that are friends or family or somewhere in your network, I would try to do a couple meetings kind of like prep meetings first and get some feedback. And the reason is there's just a lot about fundraising that is like quite nuanced. And you don't really know how you're going to show up or what's going to resonate until you actually do it a few times. And so I think those first early kind of test runs are very, very valuable. So I would certainly recommend that. In terms of actually qualifying the investors, I mean, one easy way is to go to companies you admire that are building towards outcomes that you would like to build towards, and look at who their investors were. That's one good way to do it. Another is we're in this world now where like investors put out a lot of content. We send out a lot of pings into the universe, hoping that the right founders will find us. So just like observe those pings. They're usually on LinkedIn or on Twitter, on X. And on the fund sites saying, you know, like, these are the things I'm looking for right now. These are the types of companies I'm looking at. These are the sectors I'm focused on. These are the stages. All that information is online. So I would just do your research to save yourself time and also save the investors time, such that you're only talking to people that really make sense for you. Company building and the fundraising process, momentum is helpful. And momentum happens when you're doing lots of things in a short period of time. So I wouldn't take first meetings, I wouldn't take 10 first meetings with investors over the course of 10 weeks. Try to take 10 first meetings with 10 investors in the span of 1 week, because that's when you'll get like the timely feedback, the relevant context on what people are thinking about right now. And then like you're just like in the momentum. It also benefits you in the sense of like you don't put too much take into any one investor conversation. You have a lot going on, and that ends up being impactful too.
So speaking of batching, I have an anecdote. I have a friend who flew to San Francisco to fundraise, really wanted to create that momentum. So literally took fundraising meetings only in South Park so that he could make laps, and the other VCs in the South Park office area saw him taking meetings with so-and-so. And like, there is a certain, art to doing that, right? Of like, putting yourself out there to be like, I'm in town, taking meetings, and once you start building that momentum, others want to jump on.
I agree.
Okay, so we kind of already covered this. Are there any nuances you might want to add, maybe around like qualifying a lead investor based off of fund structure, or anything that might not be in the public domain?
I think the one thing I would say is do some self-reflecting on what type of company you want to build. And by that, I don't mean like what sector or whatever, what product, more just like, do you want to run a public company? Like, do you want to build a $10 to $100 billion company that eventually is public? Or do you want to build a $100 million company that spits out $5 million of EBITDA every year for 20 years and is like, that's amazing, That I think in that case, you probably shouldn't raise venture capital, probably not from a large fund, because you probably don't want to exit, and you probably don't want someone like breathing down your neck all the time, being like, grow, 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 grow at all costs. But actually, we don't say that. We don't say grow at all costs. But
Danielle's more encouraging.
Yeah, I am. But like I think be really, really honest with yourself about what you want to build. And there's no wrong answer. I think one of the benefits of venture capital and this asset class being like a big part of culture and the zeitgeist and the business world these days is, people understand that this is a path to build really meaningful products, companies, and have a lot of impact on the world, but it's not the only way. And if it's not the way for you, you'll save yourself and your investors a lot of time and grievance if you do that reflecting ahead of time and understand that there are also some investors out there that are maybe coming from smaller funds that don't need you to be a $10 billion company.
Like Bryce from NDB and VC is a great example. He invests in companies that are going to be cash flow positive, EBITDA positive. It might be $100 million exit, and that's a great outcome.
Yeah, that's great. If you're investing for a fund like us that is quite large, we're really looking for big companies. But that's not to say like, another path isn't wonderful and great for the world and great for you. It's just, finding that alignment, I think, is really important.
Totally. This is the not ephemeral, this is the most elusive question, which is how do I find my lead investor? I always say it's kind of the 80-20 rule, like finding that lead is the 20% effort there. It feels like once you have them close and get 80% of the outcome, but getting there is like such a slog. Like what are ways you can help founders think through, like when they're in that chicken or the egg phase of like, well, so and so said they'll be in this round only until I find a lead investor.
I would, as the slide very wisely says, I would start with the lead investor. I would just focus on finding a lead before you even go talk to other people, unless the other people are like friendlies that you have a relationship with, or people that you want to like, get feedback on your pitch with and stuff like that. Generally speaking, I would start with a lead investor because that's what you'll hear for the most part from the follow-on investors is, well, we either don't know if we want to participate until we know who the lead is, or B, we will participate once you have a lead, but wouldn't participate without one. So yeah, the lead investors, I don't know if there's like a repository of this information. I think there is like Crunchbase, PitchBook, like some of these different sites online will say like these firms lead and these firms follow. So I would just do that homework ahead of time.
Right. I think given the fact that we're 4 minutes left, we can skip that. Intros and prepping for your first meeting. What are some do's and don'ts?
Ooh,
like, do you look at an intro as you're okay with a cold intro if it's like the most amazing, perfectly well crafted, like Danielle, I've read everything you wrote and here's my thesis on XYZ,
yeah,
versus a warm intro of someone who went to the same school as you?
yeah.
That was a big question.
Okay, the warmth of the intro, this sounds, maybe this is idealistic. The warmth of the intro shouldn't matter. Well, this is definitely true. If it's a founder that I'm already an investor in, and they're like, you have to meet this company, I'm meeting that company, like absolutely meeting that company. If it's a trusted partner, I'm probably meeting, and they're like, hey, you should really meet this company. They're amazing. They're a great fit for you. Probably meeting the company. In terms of like more nebulous warm intros versus a cold outreach, I kind of am indifferent. To me, it's mostly about like the quality of the perceived quality of the company and its relevance to me. I was going to say, and this is not that helpful, but just to put you in the investor mindset a little bit, the quality of my outbound and me, you can replace me with any venture investor out there, is always going to be higher than the quality of my inbound. Because the people who don't need to be reached out to are the people that, not in 100% of the cases, but like those are the people in a lot of cases that I want to meet. Not to say that as a founder, you shouldn't be reaching out to people. That's definitely not the takeaway, but that's just to put you in my mindset a little bit. So it's good to kind of be around investors before you cold reach out to them. Be posting a lot on LinkedIn. Be like, talking to, like having your customers post on LinkedIn. Just be like around in the ecosystem, sending your own pings, as we're sending our pings. And then we find each other either through one of those methods or through something else. But I think like marketing yourself in advance of those, or marketing yourself for your customers, but then investors seeing it as a byproduct is not a bad strategy.
Yeah, so much of this is content marketing and where you talk about it. Cool. So we are almost at time. Want to kind of end on crafting kind of that perfect, not perfect, but like ideal first meeting. Say, you're on someone's wish list and they worked their way up through the safe people to pitch to, the angels, the smaller EMs, and now it's like, whoa, I have a meeting with Danielle. Like, what are some do's and don'ts and things that you have been blown away by and things that you recommend founders not do?
I typically, if it's a seed or beyond, I recommend having a deck. A lot of investors are visual learners, and so having something to hold on to is very helpful. The tactical stuff, like be on time, be like, confident but reasonable, not arrogant, like someone that someone actually wants to work with for 10 years, potentially, like all those things are table stakes. I think one of the most important things is like really communicate the why now and really communicate why now, why this team, why this product vision. And you'll get interrupted a lot. It's good to have a talk track. Expect to be interrupted a lot throughout the talk track with like questions of like and interjections that will take you off your talk track. One other thing is it's always impressive to me when I can ask like 2 or 3 questions at once and the founder can keep all 3 questions in their mind and then like answer them sequentially. It just shows it demonstrates the clarity of thought and like the depth to which they've thought of something. And then one thing that's concerning to me is if investors do have a different seat and view in the sense that like we see lots and lots of companies. And so sometimes there's some pattern recognition there that maybe the founders didn't have because they're more like sector experts or operators with a different perspective. But if there's a big critical question that we've thought of as investors in the 30 minutes that you've been thinking about this, that the founder hasn't thought of in the year that they've been falling asleep thinking about this company, that's always a little concerning to me as well. So it's a long way of saying like just be prepared, be confident, and yeah, communicate those things that we talked about.
Awesome. Well, I feel like, Danielle, you've given us so much wisdom and takeaways. Thank you so much for joining us. And everyone, on the webinar and beyond, please, feel free to follow Danielle online, receive her pings. What's your Twitter?
Despite everything I said about Forex, I very infrequently post on Twitter.
Okay. Maybe LinkedIn then.
Yeah, LinkedIn and Twitter. I'm available both places, probably a little bit. Hopefully a little more in the future than today.
Awesome. Well, thank you guys for joining us and happy New York Tech Week.